Hello and welcome to Pro Trader Strategies market commentary for Friday, October the 9th. My name's Eric Wilkinson and you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, how that comes in to impact the overall markets with some market analysis. I do the same thing for you folks with the caveat that I'm layering on top of it some option strategies I find to implement into my portfolio based on those market assumptions. No, we're not just picking an option strategy out of the hat for a directional assumption. We follow some guidelines here at Pro Trader Strategies that I come up with over my 25 years of experience in order to implement the right strategy for that given assumption. So we follow specific guidelines and we will find the right strategy for any market assumption there. All right, so let's talk about the economic data. Across the pond, really not a whole lot to see there. Here in the United States, though, we did get a wholesale inventories, and it came in a little bit better than expected at 0.4%, expected to be 0.5%. Also, the car sales looked like they were doing pretty good as well. That's about it for this week, and I told you it was going to be a pretty light week for any type of economic data, so we haven't gotten a whole lot out of the markets from that. Markets really have been driven over the stimulus package as to whether or not this is going to get passed. It looks like it might be a little bit closer. They're trying to basically strip out, bailing out the pension funds for select states. And I kind of agree with that. I don't know that we should be bailing out pension funds. That's a trading mechanism. And why would you be bailing out a hedge fund or something like that for mismanaging those funds? It's not due to coronavirus that these pension funds are doing terrible. It's due to mismanagement. And I don't know that I necessarily agree with all of the bailouts going to some of the other corporations as well if they were mismanaged. All right, so without further ado, let's get on with the overall markets. And I've got Coca-Cola up here right away because I was going to talk about this really briefly because I wanted to say somebody was talking about dollar cost averaging due to my pin trade that we were talking about yesterday, and I've only done one covered call on that pin trade and it worked out quite nicely. Sold those 85 calls. That was nice. What with Coca-Cola, I want to talk about this trade. Why? Because it has been going on for the entire year, since basically February, all right? So when February and this whole thing started falling out about coronavirus, I stepped into the game with a lot of stocks. Now Coca-Cola hasn't really rebounded. Obviously, it's more of a reopening trade. And one of the things I've learned with Coca-Cola, doing some research on it, is that about 50% of their sales are through restaurants and destination type places where it would be a restaurant, maybe going to the stadium, going to the Disney World and stuff like that. Those are places where we are really consuming a lot of Coca-Cola. Now, Pepsi is diversified into the snack aisle, so that was probably the one I probably should have been going after. Coca-Cola, obviously a reopening trade and has been running against me for quite some time. So I'm going to pull this up right here and we'll just kind of go through what happened. And on February 23rd, so we can kind of throw a line in the sand here, I think it was basically this day, what I had done was gone into the Coca-Cola contract. So we're going to be doing this on Coca-Cola, and I sold the March, and I'm just going to do these as the symbols would show up as what we traded on the floor. So I sold the March 53 puts, all right, and I did that for 40 cents. So I got 40 cents credit for those March 53 puts. You can obviously see during this March contract here, this is through the March, that those were put to me at 53, which is basically up in here. So market bounced a little bit, came against me, hit that 53. I got put those stocks. So now I'm long at 53, $53, right? Well, keep in mind, I got to keep this 40 cents. Now we could look at it as an extra dividend. You can see they pay a dividend at 40 cents. Well, I look at it as it lowering my overall cost basis. So really, I am long it at $52.60, right? Because I've lowered my overall cost basis. Then what I've done is I went out and went into the April contract. So in April, I sold the 30 puts, I believe it was. The 30 puts in here for an additional 76 cents. All right. Now, I'll talk about where I covered all of those because I did cover them for some money. And then in August, I sold the August 50 calls. So I sold August 50 calls for another 33 cents. 33 cents, all right? So continuing to lower my overall cost basis, you can see a total collection here of just about $1.50 almost at this point in time. And then the 50 calls I sold, I did end up buying those back. Flipped it, sold some September 43 puts for 49 cents. All right, so continuing to lower my overall cost basis. So basically in the September, it ended up being out here for this contract. That's the August contract, I believe. So selling those as well. So you start adding all of this up, and that's how I ended up lowering my overall cost basis. And then finally, I sold the October 45 puts again after covering those 45 puts in October for the 53 cents. All right. So I bought these back for, I'm going to say 21, 21, and 14. So we got 35 is, and 14 is 49 cents. So we can add up all of this. Actually, let's add these up right here. So I've got a dollar, let's call it $1.09, and $1.09 and $1.68. So this right here was about $1.68, and I bought those back for a total of 21, so 35 cents. So I bought them back for a total of 35 cents. So now we're looking at about $1.33. All right, so that's what I've lowered my overall cost basis. I got to divide that in half. Why? Because on these, I did this one for about half of the tranche. So that was about a half of a tranche on this one, and this one. This was a full tranche, and this was a full tranche. All right, so I'm going to split that in half just to make it fair and call this about 65, 66 cents. So I lowered my overall cost basis by 66 cents there. Bought these 53s back for 14 cents. So I'm going to call this 40 cents just to say. So 40 cents. So I've lowered my overall cost basis by $1, 40 cents here, and also this 40 cents there. So I've got basically $1.46. So I've lowered my overall cost basis by $1.46. I hope that's not too confusing. Got a little bit long in the tooth here, but this is how we continuously stay mechanical with a trade that we have currently on. So lowering that overall cost basis by $1.46, you can see that the current trade right here is at 101.05. So it's just losing by about 50 cents. But the fact of the matter is I've stayed in this game from when it was in my face, continuously rolling different strategies and options. I was trying to lower my overall cost basis, do it using covered calls. I would have been happy to get out of those at the 50 call level. And then when the market pulled back, deciding to sell puts in there for dollar cost averaging if that happened. You know, I mean, I bought it at 53. I'd be happy to buy it at 43 or 45, even 30. If I thought it was a good trade, I might as well add to that as the market rolls down. You have probably a financial advisor sometimes calling you up and say, hey, you know, you're long this stock. We've gotten a pullback. Maybe today's the day to buy it. Well, why would you go out there and buy it just, flipping a coin on a daily basis where you could be doing something like this? And if you don't buy it, it doesn't get down to your level, you get to get another, you can look at it as a dividend or another lowering of that overall cost basis on the trades that you've done throughout that time. So Coca-Cola is a really good example, especially with the time it's taken, since February through this whole time. I've been staying pretty regularly diligent with lowering the overall cost basis on this trade, trying to stay in the game in these clean months. I'm not trading it during the earnings. But the fact of the matter is I'm continuously lowering my overall cost basis. I might actually do it for this upcoming earnings, sell some puts in there, get some really good strike location, and continuously stay mechanical with those types of trades. So I wanted to throw this out as an example because what's happened here is very reflective of what I just talked about with Penn, trying to lower overall cost basis on those stocks we own in our portfolio. That's how we create the hedge, and we're going to be able to beat the overall yield of what we would normally get from like an ETF or the overall broader markets. When you have these stocks in your portfolio, the only way to really outpace the market in general is to use options. And I try to talk about that a lot, but this is an example of another example like Penn of how we stay mechanical on these types of trades. All right, so without further, move on to the other markets here across the pond, or not across the pond, in the pond, we could say, for crude oil. It's coming off a little bit, but we do have some hurricanes that are kind of disrupting some of this offshore area, which would limit some supply, but it's right there at the point of control. $40.50, we can see that that's lining up perfectly between $40. 39 is the real number to kind of hold on to. As you can see, that lines up with this 50 Fibonacci. Now, it's a line in the sand, but the fact of the matter is it's more a psychological idea of keeping it above $40 a barrel there, but it is holding on to those that handle today. Gold is moving higher today by about 33 points. Again, back above that 1923 level. That is the line that we're keeping an eye on. It has acted as a major support and resistance for a very long time. So the bulls are going to celebrate it if we can get it to stay above that number today. And one thing to note is the reason why we're seeing this reinvigorated market to the upside in gold is because of the stimulus package and them coming to some agreements as to what that stimulus package is going to look like. The Republicans are trying to stay firm to their ground that, yes, we agree with all of these other stimulus, it going to the unemployment, it going to the people with the $1,200 stimulus package, it going to the airlines and some other businesses and stuff like that, the small businesses, so that they can, hold on to some employees for a little bit longer and not permanently furlough them, kind of like what the airlines are talking about. But it should not go to pension funds. I'm sorry. Yes, that I understand everything around the pension funds, and that's people's retirements and stuff like that. But it has been mismanaged. It's not an ill effect of Corona. So if they want to bail out the pensions, they need to come up with a completely separate package and not try and sneak it into this bill. As far as I'm concerned, it needs to be something completely different, an infrastructure bill or something like that, where it's just not kind of pigeonholed in there, because the people in Alaska that are in that pension probably don't, and that pension's done very well, Alaska Permafund, maybe even Calipers. I think Calipers is probably doing pretty good. It's been a bellwether kind of pension as far as I can remember. Maybe it's changed recently, but the Hawaii pension fund's doing well. Why would people in those areas need to be bailing out somebody in like Illinois, where they've siphoned out money from those pension funds to, for public projects and stuff like that? All right, with the promise that they're going to put it back in there. It just didn't happen. So that's my soapbox on that whole thing. Again, sorry, I should move on. But that, all of those things being said, we're getting a little bit of upside here because of the stimulus package. All right, bonds. Finding a bottom here right around the 173, 174 handle. Finding a little bit here. I think we're going to see a little bit of movement to the upside. The Fed governors are still talking about lower interest rates for a very long time. It seems to me to be a little bit overdone to the downside. I think we're going to start getting some stepping back up towards the 176 handle here. Probably next week it's going to start moving there. VIX coming off today as the equities are continuing their moves higher today. We can see the Dow Jones Industrial Average is up. This is a 30-minute chart, so it doesn't look like it's up. 1 day here, 30-minute chart gone. We are up on the day by about 155 points. Again, we talked about this last couple of days. I think the markets are going to continue to bounce back and forth. We've got the point of control right here that I think that the markets are going to want to migrate to. That's where the most time and volume has been spent. That I don't think we're going to see all-time highs anytime soon, and I don't think that you're going to see a massive sell-off unless maybe, you know, it's kind of really dependent on this whole talks around the stimulus package. Now, something to note here with NASDAQ, and it's not a perfect setup, but it's looking pretty darn good. Do we have the old head and shoulders? Why don't you want to write for me? Head and shoulders. We talked about this with a couple other head and shoulders. All right, head and shoulders. Basically, one shoulder there, the head there, and another shoulder there. So usually when we break the neckline here, that is a move to the upside. All right, so market's creating a head and shoulders, upside down head and shoulders. So there you have it, and it looks like the move is going to be to the upside. Only really showing up decently here in the NASDAQ, but we've been talking about these chart setups, and I thought I'd start pointing them out a little bit more regularly. But again, we have another nice head and shoulders there, breaking the neckline. That could signal a move to the upside there for equities. I'm expecting it to roll over. See, it's not as defined over here. It's a little bit sloppy on the E-mini S&Ps, but again, making a move. Do I think we're going to make it all the way up there to all those all-time highs? Reverse head and shoulders would say that that's probably likely, but I'm kind of fading that unless you know, there's some kind of crazy news that comes out. I think the market's going to want to trend consistently sideways here. E-mini S&Ps up as well, 30 points, as you can see on the breakdown in the daily chart. We saw the topping a little bit here. I think it's more profit taking going on. We saw that over in the Dow Jones with the red candles there happening in the last couple of 30-minute candles there. It's really just going to start slowing down on volume, it being a Friday at the end of the day. Not a whole lot of information coming out. People are probably glued to watching what happens with the stimulus package. And with that being said, I'm kind of sitting on the sidelines, keeping an eye on a couple of things. I am trying to get out of my Kroger trade. Again, these are where I've got the January 35 calls in there. The high was around 205. I bought it at around $1.56, I think it was. So 50% increase, and that puts me at about 225 is where I'm working to get out of it. Came very close this morning. I've gotten very close a couple of times on this trade, but a move up there into the 35 handle should be able to get me this trade with that delta being around 50. It should help out. Not a whole lot of theta decay happening there. All right, that's about it. I hope you guys all have a great weekend. Please take a moment to go over our disclaimer. We are an educational company. I'm not trying to get you guys to do these trades. What I'm trying to do is get you guys to learn how to implement options into your portfolio. And say hello to Belden. All right. If you can't take that, take it easy.